Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. It is tariff deadline day. President Trump setting a 10% baseline global rate, while imports from countries with trade surpluses with the U.S. face duties of 15% or higher. Apple delivers its fastest quarterly revenue growth in more than 3 years, with iPhone sales picking up. But Amazon's profit forecast disappoints as it spends up big on the AI race. And Mideast envoy Steve Witkoff set to visit Gaza today to inspect food distribution sites as a humanitarian crisis worsens in the Palestinian enclave. It has just gone 8 a.m. across the Emirates. I'm Juvyns in Dubai. Well, it is August the 1st, another tariff deadline day. I feel like there have been quite a few this year over the course of the year. And what we got in the last 24 hours is, well, 10% is the new zero, 15% or higher for countries that have a trade surplus with the U.S., and some of the hardest hit being the likes of Canada, South Africa, and some of those other Southeast Asian countries as well. So we're going to talk through it one by one. But the impact on markets, slightly negative tone prevailing, as you can see this morning, but not in a huge amount, not as much as none of the extent that we got back around Liberation Day in April. And it does tell you that to a certain degree, investors are willing to look past this because it removes some of the uncertainty in the air. So S&P futures down 0.2%. European markets down 0.5%. Switzerland, one of the big economies that's hit, not within EU per se, but they're being levied with a tariff of 39%. So we're waiting for opening calls on that particular market. The USD seeing a bit of a rebound. Well, not that much this morning, but over the course of the month did actually exhibit a positive month, up more than 2%. So the first positive month throughout the whole year for the USD. And then 10-year yields, we inched a little bit higher, 4.38%. Also, because we had data yesterday, let's switch over because I just want to show you the core PCE data, which is a metric that the Fed watched very, very closely, actually surprised to the upside. So you're seeing upward pressure in this core inflation print, the core PCE prints, coming in about 10 basis points higher than expectations. And again, this is one part of the puzzle. The second part of the puzzle is the labor market data today. Earlier this week, the Fed Chair Jerome Powell was talking about the robustness of the U.S. labor market. Does that hold up with the payroll prints coming out later today? That's a big question. But for now, let's go back and reevaluate how some of these global markets are reacting to tariff announcements. Asian markets, Avril Hong is in our Singapore studio and will give us a run through of what's been going on there. Avril.
Yeah, we're seeing a lot of negativity in Asia markets. There's really only one story in town. It's all about these levies, and there's been a digestion the whole of this morning at the various levels. So investors are moving to price in the impact from these tariffs. We're seeing EMs getting really hard hit, both in terms of stocks and currency. South Korea is really underperforming. This is a market that had been a market darling since Liberation Day, and then now it's almost as if it's run out of good news to price in. And for the likes of Taiwan, another market that is underperforming today, 20% tariff rate that it says is temporary. Negotiations still set to continue, but it's still higher than what South Korea and Japan were struck with, 15%. And of course, these are all export rivals, so how is this going to affect their competitiveness? Now, aside from that, worth highlighting as well that when it comes to the Hang Seng, is not faring as badly as some of these other major markets today. This is following on from Alibaba, Meituan pledging to address the price wars, and this is following on from warnings from Beijing. So that's helping to cap declines on the Hong Kong benchmark. But as I said, it's really about the tariffs, and you're looking at the region's benchmark actually on its longest losing streak so far this year, headed for a sixth session of declines. Jumana.
Avril, thank you so much. Avril in Singapore. Now, President Trump has announced new tariffs, including a 10% global minimum rate and 15% or higher duties for countries with trade surpluses with the U.S. For more, let's bring in senior editor Bill Ferries and China correspondent Min Min Lo. Bill, I'm going to start with you. We knew this day was coming. Are there any surprises in what was announced by the U.S. yesterday?
Yeah, I mean, I think some people would say that even the 10% rate wasn't a given, even for countries with a surplus. So that was probably a pleasant surprise for some nations like Singapore, who have already said that they could probably live with that kind of level. In terms of, the other surprises, I think looking in the opposite direction, 39% for Switzerland was probably a big shock. That country is a major exporter of pharmaceuticals to the United States. We're going to have to wait and see what the impact there is, but it certainly comes as a big surprise given what other countries, even in Europe, have dealt with. 20% for Taiwan that Averill mentioned there earlier is higher than the 15% that countries like Japan and South Korea got. So that's probably come as an unpleasant surprise. But obviously a huge economic experiment. I think the big picture here is that U.S. tariffs are seen as climbing over 15%. Under this new regime compared to just about 2%, 2.4% before President Trump took office 6-7 months ago.
Yeah, I mean, that's the major takeaway if you want to think about the impact specifically on the U.S. economy. Let's pick up the conversation on Taiwan. Min, let me just ask you, because Taiwan also got that rate of 20%, but it seems as though they're still actively engaged in negotiations with the U.S., despite the fact that the deadline technically has passed. What do we know about what may happen with that Taiwan rate, and as it pertains to a key sector there, which is the chip makers?
Yeah, Taiwan is definitely not satisfied with the 20% rate, and the government saying that this is just temporary. They are going to schedule the next round of trade talks to try to lower tariffs, and in particular, they really want to get a favored rate when it comes to chips, because the Section 232 investigations are not yet concluded. Potentially, there could be more sectoral rates imposed on semiconductor, and that is going to be a big blow to companies like TSMC and to the broader Taiwanese economy as well. You think about the export rivals, South Korea, Japan, both getting 15%. So 20% for Taiwan really puts them on the back foot, and it really puts them on par with some of the Southeast Asian countries like Malaysia, Indonesia, Philippines. And it raises the question of exactly what is the importance of Taiwan to the United States. You think about the backdrop here of the U.S.-China trade talks ongoing at the same time, and how the U.S. had reportedly blocked the Taiwanese President Lai Ching-te from lending or stopping over in the U.S. en route to other countries. That has raised the question of whether the U.S. is willing to trade away Taiwan as just a bargaining chip to get a better deal with China.
Yeah, and let's talk about China, because there's another deadline there. It's very difficult to keep track of all these deadlines, but I think the China deadline is on August the 12th. How is yesterday's announcements going to be factored in to what might happen with the China potential truce extension that Scott Bessent referred to earlier this week?
Yeah, August 12th is a deadline. President Trump has yet to announce whether or not that trade truce will be extended, despite signals from the likes of Scott Bessent, from Howard Lutnick, saying that potentially there is going to be an extension. But for now, yesterday we saw really positive sort of signals from the Chinese side, the Chinese ambassador in Singapore even praising how the U.S. had negotiated on good faith. And you really can't decouple the Taiwan trade deal with the China one, because the fact that, potentially the blocking of the Taiwanese president from lending in the U.S., that was potentially a big concession to China. And then, there's also a bit of complication now, because recently, just today, there had been reports of Chinese government department summoning NVIDIA over concerns of security risks there. The idea that the U.S. will be putting in these ability to track remotely where these chips are going into, and that security risk could potentially derail those talks again, because it shows that it raises the question of whether the U.S. was indeed negotiating on good faith when they agreed to reverse the decision not to ban the H20 chip exports to China. So a lot of moving pieces here. We're still waiting for President Trump to announce what that trade deal is, or that trade extension, whether it's going to happen, and what eventually that deal is going to look like if the two presidents actually meet later this year.
Yeah. A very good point on NVIDIA. It's amazing how frequently that company comes up in the context of China-U.S. discussions. Bill, maybe let's just put this all together, because we spent the last couple of months trying to analyze the impact all of these tariffs are going to have on the U.S. economy and more broadly on the global economy as well. At this point, assuming that these rates actually do hold, because this is supposedly the hard deadline, what are we anticipating the impact could be? And ultimately, does it go one step further to achieving President Trump's aim of rewiring the global trade system, perhaps in more favor of the U.S.?
Well, it's definitely going to have an impact on the global trade system, as Min Min mentioned. I mean, it is already prompting a lot of discussion about how it may affect, rival competitors. So you have the situation with Taiwan at a higher rate than Japan and South Korea. That's certainly going to affect some companies' investment decisions and the ability of those countries to export. And what their GDP numbers come out to. It's a huge global economic experiment of the kind we haven't seen in decades. This effectively puts U.S. tariffs at their highest rate since World War II. We've already seen some analysis saying it could take 1.8% or more off U.S. GDP in the years ahead. And, even though a lot of companies ramped up imports ahead of this time, it's hard to see how this doesn't start to filter through on the inflation front as well. So it's going to have a massive impact. The deals that we've seen that include promises of purchases of U.S. energy or investments in the U.S., there's a lot of details remaining to be worked out on that front. We just don't have clarity. So in terms of whether this has the impact that President Trump intends, which is reducing trade deficits with countries, boosting investment and manufacturing in the U.S., that's going to be an open question. And I would just add to all that, August 7th does look like when this is coming in. I think every country out there is going to continue to try to negotiate down these rates after August 7th. President Trump likes to make deals. He will probably entertain deals after these go into effect if he can get that. So China's out there, Mexico's out there. A lot of other countries want to get their foot in that door.
Yeah. Well, more like soft deadlines for many of these deadlines. Bloomberg's Bill Ferries and Min Min Lo in Hong Kong. Thanks to both of you. Okay, let's pick up the markets conversation. Joining us now is Vincent Juvyns, Chief Investment Strategist at ING Belgium. Vincent, it's really good to have you on the show today. One thing I noted right at the top when I was walking through the market price action is we're not seeing as an adverse reaction today as we got back in April, the original Liberation Tariff Day. Do you think markets have reached a point of headline fatigue when it comes to tariffs? Is that why they're willing to mostly look past some of the announcements of the last 24 hours?
I wouldn't maybe call it fatigue. I guess everybody acknowledges that it's important, but this deadline should be interpreted as flexible deadline. And we've seen over the last couple of weeks that really the willingness of the U.S. administration is to reach a deal. And ultimately, the deal which has been reached with a couple of countries already, including with the European Union, are more favorable than what was originally planned. So clearly, the tariffs which have been negotiated are generally better than those announced on Liberation Day. I'm quite convinced that those tariffs which have been implemented today will probably be watered down as we move forward.
But what about the growth impact? I mean, the way I'm sort of thinking about this is perhaps there's less of an uncertainty shock now, but what is going to pan out over the next couple of months is quite a severe growth impact, especially on the likes of Europe, on Switzerland, on some of these economies that are facing these really high tariff rates. Is that not something to worry about in the coming quarters?
Oh, definitely. We are feeling the pain already. I would say more in corporate earnings at the moment than in the real economy. So we have seen we are in the midst of the earnings season in Europe, and you see clearly an impact of this tariff uncertainty and a higher tariff overall. So it's hurting trade. The golden age of globalization is definitely over. So from a pure economic standpoint, it's true that the coming year are going to be a bit more challenging on that front. Economically speaking, I would say what's surprising over the last couple of days and weeks is the resilience of the economy. So the economy seemed to cope with this relatively well. We had the IMF World Economic Outlook update earlier this week, which actually upgraded its growth forecast for this year and next, including for Europe. So clearly, there's a sense within the economist community that what we have to digest now in terms of tariff is obviously not great. These are the highest tariff in a century, but it's obviously much more acceptable than was what announced earlier in April. So this economy will need to adjust to this new reality. I see a clear winner in all this. So It's clear uncertainty in the US about the true impact of tariff, but the commitment, the investment commitment which have been secured, which come on top of the investment already made by large cap in the US, will definitely make that the Europe will continue to outgrow many developed markets.
Assuming those investments actually do happen, that's the big question. There's a difference between an actual commitment and putting the money on the table. And then there's obviously lots of questions about how, for example, Europe will fund some of those investments. But I just want to turn to markets because we're right in the middle of earnings season. What is your takeaway so far on what we've had from both US and Europe?
Very strong earnings season in the US from the usual suspect that you would expect. We are long IT since the beginning of the year, and we are really pleased to see those strong numbers coming. And maybe a good link with your remark, Jumana, about investment. Clearly, there were questions at the start of the year with this DeepSeek story, whether tech stock would continue to invest so much in their business, in their ability to continue to grow in the AI space. And you see that those investments are still happening and the commitment remain in place, and that these are bearing fruit in the earnings. Great to see a second company trading with a market cap above 4 trillion. You continue the
4 trillion.
Complex doing well. On top of that, maybe a more traditional sector, my sector, financials doing quite well as well. In the US, it's more a deregulation story. In Europe, it's more obviously a low rate environment which fuel mortgage origination and loan demand. But clearly, some good development in the US which are reassuring us. And clearly, we have been building our position in the US so far this year. Europe remain a pain point. We have a lot of enthusiasm about Europe earlier this year, but you see that the earnings season is clearly reflecting those trade tension. You see that clearly earnings growth is obviously much more muted than in the US overall, especially in the export-oriented sector. So a bit of prudence in our asset allocation towards Europe at the moment.
Very clear. Really good to have you on today. Vincent Juvyns, Chief Investment Strategist at ING Belgium. Thank you. And coming up, the White House says U.S. envoy Steve Witkoff is set to visit Gaza today. We're live in Jerusalem with more details next. This is Bloomberg. President Trump's special envoy, Steve Witkoff, has arrived in Israel to discuss the worsening humanitarian situation in Gaza. He met with Israeli Prime Minister Benjamin Netanyahu, and the White House says Witkoff is expected to inspect food distribution in Gaza later today. This comes as the Trump administration imposes sanctions on members of the Palestine Liberation Organization, PLO, as well as the Palestinian Authority, a counteraction to other countries moving towards recognizing a Palestinian state. Let's go to Jerusalem now and speak to Bloomberg's Dan Williams. We reported on Witkoff coming to the region to Israel yesterday. He's now there. He's met with the Israeli Prime Minister. What do we know about what happened during that meeting and what is expected to ensue later today?
Little has been publicly said. It's worth remembering that this man, Steve Witkoff, is a trusted envoy of the US president when it comes to the Middle East, not just the Middle East, also in the Ukraine crisis. He does tend to keep his own counsel. However, it has been announced that in addition to those meetings that you cited this morning, he will be visiting a station run by the Gaza Humanitarian Foundation. That is an alternative aid distribution system set up with the support of the United States and Israel a few months ago. In lieu, Israel had hoped of traditional UN distribution, which it accuses of effectively bolstering Hamas rule in the Gaza Strip. Hamas has been opposed to the GHF. It actually wants the GHF disbanded as part of any ceasefire that might be achieved in Gaza. A ceasefire seems a very remote possibility right now. So it would appear that Witkoff is going there to inspect it, to see whether things are running well. And I imagine the GHF will want to dispel recent reports suggesting there has been mismanagement, including lethal mismanagement, around those aid distribution stations, mounting allegations of deaths from shooting from stampedes in the vicinity vicinity of those stations. The GHF says it is not involved in these. Its people did not open fire. It would appear there has been some involvement of IDF troops and potentially Hamas on the periphery. But again, these rumors, these allegations, these reports have dogged what is meant to be, as far as the Americans and the Israelis are concerned, a pure humanitarian mission that could potentially be expanded in scope.
Yeah, with a dire need for the expansion of that humanitarian assistance. The world's shocked by some of the images still coming through from Gaza. Yesterday, the Trump administration announced that they're imposing sanctions on members of the PLO and the Palestinian Authority. And of course, the Palestinian Authority are a group that lack authority to a certain extent. They're sort of a shell political organization. What do we make of these announcements and the timing versus it coinciding with a big push from many countries around the world to move towards granting statehood to the Palestinians come September?
Well, this really was a bolt from the blue, diplomatically speaking. The PLO, the PA have really been in good standing with the international community, at least since the early 90s, the 1991 Madrid Peace Conference, the 1993 interim Oslo peace accords with Israel. So it would appear that this did not happen in a vacuum. The cascade of Western powers, specifically European powers, including actually Canada in North America, in recent days suggesting that they want to recognize a Palestinian state as soon as September, and as such would see the Palestinian Authority as the presumptive government of that Palestinian state, including the Gaza Strip. It would appear that the Americans are trying to cool that ardor by saying that as far as Washington is concerned, the Trump administration, the PA, the PLO are very troubled organizations, troubled agencies, a troubled state in waiting, if you like. And this would also tie in with Israel's demand that the PA, as it stands currently with its current leadership, would not be admitted to the Gaza Strip for a post-war government. So there's a lot of jockeying here over what the future of the Palestinians is going to look like in terms of Western powers.
Yep. Bloomberg's Dan Williams in Jerusalem. Thank you so much. Well, coming up, we're going to pivot and talk about two tech majors. It's a tale of two of them. We dive into the details of the diverging results from Apple on one side and Amazon on the other. That's coming up next. This is Bloomberg. Apple shares jumped in late trading after third quarter revenue topped analyst estimates, boosted by strong iPhone sales in China. The CEO, Tim Cook, says growth accelerated around the world, including in Greater China and many emerging markets. He says Apple is increasing its investments in AI and is open to acquisitions to accelerate its roadmap. But Amazon shares tumbled in late trade after it projected lower than expected operating income this quarter. That's seen investors worrying that the tech giant is spending too much to keep up with its competitors in artificial intelligence. So a tale of two sides. And coming up, we discuss the South African economy in light of the 30% tariff and the central bank's rate cut with Investec's Annabel Bishop. That next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Well, it's tariff deadline day. President Trump setting a 10% baseline global rate, while imports from countries with trade surpluses with the U.S. face duties of 15% or higher. Apple delivers its fastest quarterly revenue growth in more than 3 years, with iPhone sales picking up. But Amazon's profit forecast disappoints as it spends up big on the AI race. And we speak to Annabel Bishop, chief economist at Investec, on how South Africa is preparing for a 30% levy allocated by Donald Trump, one day after the South African Reserve Bank cut rates to the lowest level since November 2022. It has just gone 8:30 a.m. across the Emirates. I'm Juvyns in Dubai. Well, today it's all about tariffs and tech. So tariffs, once again, the August 1st deadline. What we got was a whole bunch of new higher tariffs leveled at countries around the world. 10% is the new zero, 15% being leveled at countries that have a trade surplus with the U.S. or even higher, as in the case of, for example, Switzerland, 39%, South Africa, 30%. Canada also sitting at 35%. Thailand 20%. So there's still a lot of these discussions up in the air. I meant Taiwan up at 20%. A lot of these discussions still up in the air. But again, we're getting some certainty perhaps on what these final rates are going to look like, at least for now. Markets are reacting. S&P futures marginally weaker, down 15 basis points. For the month, though, July, we're up more than 2%. So it has been a good month for U.S. equities, propelled by tech, as we were talking about. Strong earnings yesterday from the likes of Apple. And of course, the day before we had Meta, Microsoft. Yesterday, Microsoft briefly broke through $4 trillion in market cap. So strong there despite the underperformance of Amazon. European markets look like they're going to open up in the red, down 0.4% this morning as we speak to marginal gains for the month. So an underperformance versus the U.S. The USD not doing a whole lot, but still a positive month for July, up more than 2%. And then 10-year yields unchanged today, 4.37, despite the fact that we had better than expected inflation data yesterday. Gave a bit of an up boost to the yield curve yesterday. And here you can see that U.S. core inflation, that metric that the Fed like to look at, PCE, surprised to the upside. So inflation is a little bit sticky, I would say, in the U.S. And that's, of course, relevant for the Fed's decision-making on interest rate cuts from here. And, of course, later today we get non-farm payrolls, which is another important set of data that the Fed are going to be watching out for closely. Okay, let's switch over and talk about the impact of all of this news around tariffs, and now specifically on how some of these Asian currencies are reacting. Avril Hong has more.
Yeah, Jumana, against the backdrop of the bounce in the dollar, given these tariff announcements, it's really interesting to see, yes, we have the firmness of the yen, but it is still above the so-called danger zone 150 level against the greenback. It's kind of being hit by a double whammy of sorts of a hawkish Powell and a dovish Ueda this week. But aside from that, highlighting as well the moves in onshore, offshore renminbi, the Chinese currency, of course, that is slipping against the backdrop of that, as I said, dollar bounce. And this performance you're seeing this week could be its worst since early in the year. I would also just highlight this Asia dollar index, which captures the South Korean won, which is today among the underperformers, but also captures some of the other Southeast Asia currencies, such as the Malaysian ringgit and the Thai baht. There's the view emerging, and certainly this is what the Malaysian Trade Ministry has been highlighting, that even at 19%, this deal has been sort of a positive outcome, and we're actually also seeing Malaysia stocks rallying, outperforming quite hard today. So the idea that at least now we know what kind of levies, the levels they're going to have to be working with to mitigate potentially the impact of these tariffs going forward as well. Jumana.
Avril, thanks so much. Now, President Trump's sweeping new tariffs mean imports from about 40 countries will face the new 15% rate. And roughly a dozen economies' products will be hit with even higher duties. One such country is South Africa, which has been hit with a 30% levy. However, before that, the South African Reserve Bank cut interest rates by 25 basis points to 7%. That's as the central bank has been expecting tariffs to weigh on its already faltering economy. For more, joining us is Annabel Bishop, chief economist at Investec, and, of course, our chief Africa correspondent, Jennifer Zabazaja, also joins me, and she recently spoke to the South African Reserve Bank governor, so we can pick up the conversation there. But Annabel, I want to start with you just on this tariff announcement overnight. That 30%, is that higher than what most analysts, economists were penciling in? And if it is higher, what sort of an economic impact are we talking about on the South African economy?
Yes, hi. Thank you for having me on the show. Look, I think, we had it well signaled to us that we were going to get a 30% tariff increase, but there were strong hopes as well that we could work it down towards the 15% mark. The impact of the 30% is really going to be heavily felt on our motor vehicle sector and agricultural exports. Unfortunately, the impact will have a negative impact on economic growth, but our exports to the US in total are around 7%. So we do see some relief in terms of our metals and minerals, where there is no tariff implied on certain of those. Overall, we think the growth impact could be around about 0.2%, but it's going to take quite a while to feed through, and of course, maybe less than that. All depends on ability to find external markets elsewhere, and of course, as well, the impact globally on the US and other countries. We're looking to see what that's going to be on international inflation rates and how that obviously feeds through into financial markets.
And Annabel, let's just pick up on that inflation rates, because as Jumana was just mentioning there, of course, we heard from South African Reserve Bank Governor Lesetja Kganyago deciding to make this cut, which many analysts were expecting. But why do you think then he made the decision now, considering a lot of uncertainties, just given the implementation now of August 1st and the tariffs on the economy?
I think it's a very good move. You know, we need lower interest rates in South Africa. Our real interest rates are very high, with inflation running at 3%. And of course, the move to now look to target 3% instead of the 4.5% point in our target range. That really means that South Africa is going to be on a lower inflation and lower interest rate trajectory going forwards. And that's going to obviously be supportive of economic growth. So we do find ourselves in a situation where we might have no interest rate cut for the rest of this year, but then moving into next year and the next few years, we could see lower interest rates, and ultimately that will help to strengthen the economy.
Does the dollar and the activity, though, of the dollar and potentially the rand performance right now, we're looking at the rand being little changed, but does that change potentially your analysis of the trajectory moving forward?
So we've taken out our interest rate cut for this year. We expect no cuts. Next year, we think there could be a cut, one cut in the middle, around the middle of the year. But having a look at the rand is actually weaker than it was yesterday, and that's partly because we've seen some substantial strength in the US dollar versus our currency, and that's been the main driver. However, the rand also does have some risk reflection, and of course, the concerns around the uncertainty of the tariffs do obviously reflect in there as well. But we think as we move through the course of the rest of, the next few days, certainly over the course of next week, there could be some gains in the domestic currency as markets start to factor in the positive impact of targeting a lower point in the inflation target range, and obviously the positive growth impacts.
Annabel, let me ask you about that. One line stood out to me from the press conference yesterday. The NPC now prefers inflation to settle at 3%. Should we just read that as the new de facto inflation target before it gets crystallized later this year in the budget?
So I think, there's a couple of points at play here. One is that the new target range is likely to be narrower. So instead of having the 3 to 6% target range we have now, they might look at a 2 to 5 or 2 to 4, which seems more likely, given that the midpoint's probably going to be that 3% we're talking about. From a target point perspective, yes, we obviously are trying to reach now the 3% mark on a sustainable basis, but I think there will be some flexibility around this. We don't, for example, think that there's going to be a hike in interest rates this year when inflation starts to track up to 4%. That's base effects, and of course the Reserve Bank's likely to look through that. We certainly think that they will continue to target inflation on a longer term basis. So that's looking at the inflation forecast the inflation forecast 6 to 24 months out at that 3% point. So that's really, I think, the way it's going to be.
Yeah, so interesting, and obviously a big topic of conversation over the next couple of months, whether they modify that inflation target. Annabel Bishop, Chief Economist at Investec, and our Chief Africa Correspondent, Jennifer Zabazaja, thank you so much. We're also keeping track of earnings coming through from Africa. It's been such a busy week for earnings around the world. Let's kick it off with Diageo. Its East Africa unit reported annual profit growth after 2 years of slowing earnings as Forex losses dropped. For more, Bloomberg's Andiro Ganga joins us now from Kigali, Rwanda. Andiro, so East African breweries returned to a profit amid talks of Diageo reviewing the business. Tell us more.
Hi, Jumana. Yeah, they have returned to profit, and this can be attributed to a couple of things. If you look at the Kenyan shilling, it was a big contributor in 2023. It lost 20% of its value to the dollar, but gained by the same amount in 2024. And it has been holding steady, expected to continue with the same trajectory all the way to 2026. The dollar is cheaper, hence the cost of importing raw materials for them is slightly lower. We've also seen lenders repricing their loans, and they've become quite more affordable because the central bank has been cutting rates. But despite this good indicators and even posing a 12% increase in profit, they're still looking to exit this market, and they've so far tapped Bank of America and Goldman to do a strategic review so that they can begin the process of exiting that market. Though this review is still very much in its early stage, they'll be looking to sell 65% of their stake at ABL, and Heineken and Castell are being tapped to be the potential buyers of this. And this is part of their global strategy where they're trying to adopt an asset-light model and reduce volatility on the African continent and also free up some revenue for their growth. And we've seen them exiting Nigeria, Ghana, and also Seychelles.
And MTN Group's Nigeria operations also upgraded their full-year guidance. So what do we know there?
Jumana, again, lower risk from foreign exchange headwinds, and also they were able to get approval to hike tariffs faster than they had expected, particularly in the first quarter. And this is reflecting in the second quarter. We saw them post very strong results in the second quarter of the year. And because of this, we're seeing their shares up by 8%, which is the highest intraday level since August of 2022. But also, they have diversified their business in terms of data, calls, and fintech. And this is some of the factors that are propping up the business and the solid performance that they post.
Yeah, pretty solid performance. The stock is up 90% in the last year. So that tells you, I guess, a lot about how it's done. Andiro, thank you so much for giving us the latest overview of some of the earnings from the region. That was Bloomberg's Andiro Ganga in Kigali, Rwanda. And coming up, we discuss earnings and M&A with Adnoc Drilling CFO as the UAE firm targets expansion around the world. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Well, to earnings, Adnoc Drilling is forging ahead with its global expansions plans. With more M&A, the UAE-based firm is planning to buy a company operating oil and gas rigs in Kuwait and Oman, which would be the second such deal in less than a year. And of course, this is on the back of record results from the company reported 2 days ago. For more, joining us now is Youssef Salem, CFO of Adnoc Drilling. Really good morning to you, sir. Let's start with the earnings. Record first half year profit. Talk us through what is driving this performance.
Morning, Jumana, and thank you so much for having me. Indeed, a record quarter and a record half, our best ever 3 months and 6 months in the history of Adnoc Drilling, and the 8th time in a row that we come with record results and ahead of market expectations. That was driven by growth across the entire company. Our fleet has reached the record and the largest in the entirety of the Middle East and North Africa with 149 rigs. Our oilfield services is still the fastest growing with more than 100% year-on-year growth. Our technology implementation has now reached 140 patents housed within our technology and AI platform, Enersol. So it's really growth across the board. And it's continuing and sustainable growth. We've upgraded the guidance for the second half of the year.
I saw that. So I want to ask you about it. You did update the guidance, and that we walk in today and there's news of more tariffs, more global uncertainties. Are you not concerned that some of this momentum may get dented by some of the global macro headwinds out there?
The unique thing about Adnoc Drilling is we operate with 15-year contracts that run until 2040 and beyond. We won around $5 billion of new contracts in the first half, and that completely de-risks our guidance and growth. And that's why we're very comfortable committing to this upgraded guidance. And that's also why we're the only company in the UAE that pays a progressive quarterly dividend that's committed for at least 5 years.
Yeah, we've been hearing of U.S. drillers starting to slow down on production and extraction in the United States. Does that create a comparative advantage for Adnoc on a global scale?
Yes, the UAE benefits from having the lowest cost per barrel globally and the lowest emissions per barrel globally. And that's why the UAE and Adnoc are pushing ahead with their plans, which Adnoc Drilling, as the sole driller in the UAE, is the exclusive enabler of these plans and national targets to reach 5 million barrels per day of oil by 2027 and a substantial increase in gas. So the UAE does have this competitive advantage, which trickles down to us as the sole enabler of that and extractor of that advantage.
Yeah, and you speak to your geographic expansion, the deal with SLB, to take over a majority stake in some of the oil and gas rigs in Kuwait and Oman. Is that the extent of your geographic expansion, or would you look beyond Kuwait and Oman as well?
constantly looking for opportunities globally through Enersol, our technology and AI platform. We've already completed 4 acquisitions that between them operate in 40 different countries, focusing predominantly on AI for energy, computer vision, predictive analytics, and other technology offerings. And we'll continue to do another $750 million of investments from the Enersol vehicle across the globe. Similarly, for our regional expansion directly by Adnoc Drilling, we started with this transaction with SLB, who's been operating for Oman for over 55 years and has been operating in Kuwait for a good number of years as well. And we look to unlock as well the national targets of Kuwait going to 4 million barrels per day, similarly contribute to Oman's growth ambitions and take our integrated technology offering beyond the UAE.
Yeah, you're sitting on a lot of free cash flow. I saw in the second quarter of 2025, free cash flow stood at $408 million versus $282 million. So you do have the cash if you want to go and make some more acquisitions. Are there any specific sectors that you're looking at in terms of potential future acquisitions?
In terms of use of cash, for us, first, the top priority is to continue to increase distributions. Today, we have a progressive dividend policy that's the most attractive in the Middle East, and that provides full board discretion to upsize dividends even above the floor, and we'll continue to return more capital to shareholders and create more shareholder return. Secondly, we'll continue to grow both organically and inorganically. From a sector focus, our biggest focus is technology. We believe we can continue to add significant value, especially as part of Adnoc Group's overall energy AI program, which basically adds significant value to operators using AI. That will continue to be our top priority. And then after that as well, continued rigs and drilling expansion.
Yeah, I noticed 2 of the deals that were inked this quarter were in the artificial intelligence space. Talk to me about how AI is enhancing your operations or growth additive. At this point, is it more of a cost or does it actually fundamentally add to the growth outlook as well?
It is fundamentally adding because it's unlocking new revenues for us. For example, we're in the process of building new 6 AI-enabled rigs. These will contribute to us $1.4 billion of revenues over the course of 10 years. So it's unlocking additional revenue opportunity. It's also the safety of our people. We are implementing rigs across all our smart cameras across all our rigs, which is pre-detecting any potential accidents and keeping our people safe. And third, it's the effectiveness of our management and board. We had our board meeting a couple of days ago where Mirai, our AI board observer, joined for the first time, improving the effectiveness of the discussions and the governance at board and management level.
Oh, interesting. So you have an actual AI bot attending your meetings. We need to get one of those over here at Bloomberg. Youssef Salem, CFO of Adnoc Drilling, thank you so much for joining us on the show today. Really appreciate your time. Coming up, U.S. non-farm payrolls will be released later today. With all eyes on the unemployment rates, we'll have the details for you next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Juvyns in Dubai. Investors are awaiting the July jobs report out later today. The Fed Chair Jerome Powell says the main number to watch is the unemployment rate, which reflects the balance of labor supply and demand. Bloomberg's Valerie Teitel joins us now. I'm so used to talking about markets. What can we expect from today's non-farm payrolls, Val?
The consensus estimate, Jumana, is for 104K, with the prior reading being 147. 104K would actually mark one of the lowest readings we got this year, the lowest since February, actually. A lot of the attention will be on the unemployment rate, as Powell dragged our attention to this in the press conference a few days ago. It is expected to tick up to 4.2% from a prior reading of 4.1%. There will also be some attention on the participation rate as well. It's expected to stay steady at 62.3%. But the reason why I draw your attention to it is there's been a lot of flux in the labor market recently because of the deportation of undocumented workers. Jumana, this is one of the things that Powell talked about in his press conference, saying there is a dynamic happening in the labor market where you're seeing labor supply decrease alongside labor demand. If that happens actually in tandem, the unemployment rate could stay steady. But if either of that comes out of flux, if perhaps we have a bigger bigger drop in labor demand than the drop in labor supply. That's a scenario where you can see the unemployment rate rise. So that is why that's important today. Powell drew our attention to it yesterday. He did say that there is still no evidence of weakening in the labor market, but he does see downside risks because of these underlying dynamics.
So let's bring it back to the Fed meeting that we had earlier this week. The Fed Chair Jerome Powell indicating that they're sort of in wait-and-see mode, but still observing the labor market very closely. How will today's numbers affect, you think, whatever is being priced into the market in terms of rate cuts from now until the end of the year?
Well, Juvyns, the print today could vindicate maybe two of those members who dissented in the meeting a few days ago. One of the main dissenters, Governor Chris Waller, argued that the labor market was on edge and that it was flashing red, which stood very much in contrast to the rest of the FOMC, who in their statement still characterized the labor market as solid. So today's print could perhaps make some part of those members of the FOMC happy or not. But you're right, we have priced out a lot of the cuts into the remainder of the year. After the Fed decision a few days ago, October is no longer fully priced. So a strong print today could start to tempt out more of those rate cuts priced into the remainder of the year.
Yeah. OK. Well, always a fun day, NFP. As we head towards the end of what's been quite a momentous week, last week of July, with everything that's gone on in the markets. Val, thank you so much for making sense of it all for us. Speaking of those markets, let's take a look at how equity futures are faring. The latest slew of tariff announcements coming in: 10%, the new baseline, 15% for countries with a trade surplus with the United States, or even higher, as in the case of Canada and some of the other countries that we were talking about, South Africa as well included. But this is how markets are faring, all of them pointing to open down in the red. European markets the most, down 0.5%. But that was it for Horizons Middle East and Africa. I'm Johanna Versace in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.